Okay, so here we go. This is the Tortoise Weekend report review for June 7th, 2014. We have a market that is in bullish, quiet conditions. On an annual basis, using weekly RSI 14, we're at 72 out of 100. So we're into overbought. Now, it can stay overbought for a long time, but that's an indication of just how strong this move has been. On a 10-day basis, using the 10-day NDX, we're at 99 out of 100, so, excuse me, overbought. Looking at the market mosaic price with respect to the 200-day moving average is a white bullish, 8.85, so we're almost 7% cushion to sideways. That's an improvement. Slope of the 50 improved to white bullish at 0.47. The ADX 14 has now strengthened to 20.8, so it's neutral from weak. And that means we still have room to go in this intermediate trend, which is now voted to the upside. ATR percentage is kind of a remarkable 0.59% of quiet. The risk index is the 30-period moving average of the VIX divided by the 10. And that gives us a number and to demark risk on versus risk off. The boundary is 1.0. So if we're greater than 1.0 on that number, we're in risk on condition, and that's where we are right now. We're at 1.08. We remain there, 1.08. So risk on is favored. That's the riskier assets are favored, and you can see that that's been the case, a favorable case really for the last 30 days. That indicator's been saying buy and hold. Find the riskier assets and leverage them. If we take that reading of 1.08 and look back 5,000 days and find the standard deviation of today's reading against that 5,000 days, we get the risk Z, which is at 0.90. So it's almost one full standard deviation above the zero line, which is, again, that boundary between risk on, risk off. And so this is the 90-day histogram of that. You can just see how favorable the inverse volatility trade has been. It's at a what has been a local maximum at near 1. So I really am taking that swing trade a day at a time. It's been this is a long period of time for that to be so strong. So it's actually pretty remarkable just how quiet the VIX has been, and the market has been complacent to the point where the Fed is even saying something. So as we can see here, the reversals out of that can be sharp indeed. So make sure your stops are in place on your swings. The blended monthly rebalancing happened last week with the next reevaluation due on or 1 July. These are the holdings for each of those ETF portfolios. And the current leaders based on the current readings of the database. And you can see in the current readings it shifts to a more growth-oriented or high volatility growth holdings. And then these are the top holdings in the Dow 30, ETF 200, and ETF Max. Still a lot of India and emerging markets, a lot of Brazil, a lot of Latin America being shown. Intel was just remarkable this week. In ETF 2, the theoretical exposure is now finally back up to 100%. The model portfolio is at 100%, and it buys a position in ILF this week. These are the holdings inside of the ETF 13 and ETF 32, just to take a quick look. And you see everything in the 13 is on a buy position, and in the 32, again, you'll see Brazil, energy, Latin America at the top with some remarkable numbers. It's come a long way since it used to be the worst. So it pays attention, paying attention to these relative locations pays off. In the ETF Max, you'll see it's being dominated by the India, commodities, Turkey, Gulf states, Brazil, Egypt, U.S. natural gas. So definitely a shift to the emerging market style. Daryl asks, any concentration concern between in ETF 32 between EWZ and ILF? No. They're both very broad indexes. That's where the strength is. It essentially takes a double position on it. If you're concerned about it, you can look at the take position number 4 would be a way to respond to that. You could look at utilities or emerging Europe, but I follow the model. One of the things you get by concentration among the relative strength leader. I mean, if you were ever going to take a position focused on Latin America and Brazil, this would be the month to do it. I mean, you have the entire market is moving up with strength, hitting all-time highs. It's a bull quiet market. Brazil and Latin America are early in their rebound, and you're seeing broad strength in all the emerging markets. So to me, that's the time to concentrate, and that's what the model says. So I'm just following the model. In the S&P 500 lens, you'll see the winners on the basis of the blended monthly look back, same lens, and it also includes the sector that they are members of. So you can see what's contributing to the outperformance of those sector spiders. Excuse me. We're going to move on to the health check. And then this just looks really good. I mean, you have vertical blue lines are 10, 20, and 30 days worth of look back. We're in a bull quiet mode here. The horizontal red lines are support levels that used to be resistance levels, which act as price targets on the way down, but which should act as support. In the green area, generally, my default position is to want to be long. So at the first sign of intraday strength, when we're in the green zone, I'm going long the strongest sector. If price were to come back into the yellow zone here between 192 and 184, that's where I wait intraday for the market to sort out what kind of day it's going to be, and then go in that direction. And then in the red zone, I have a default position of being trying to be short the weakest sectors or long the inverse, excuse me. So we're clearly into the green here, making all-time new highs. Price is outside of the floodplain, outside of the river, and now the dragon is completely outside of the river. It's hard for that to stay there that long. The last time the dragon was kind of in that position was back here in early March, and you can see there was a short-term local high established and then a pullback almost to the Bollinger Band mean. In this case, if it was held true, it'd be a pullback to like 189-ish. But even when the dragon wasn't completely out of the river and price never got out of the floodplain, and here we've been, there was a crescendo of buying here on Friday. And so that's the concern I have right now. It's just already well extended. The pullbacks in a bull, as you see back here in March and early April, you can have those big, powerful one-day adverse moves. Those moves were caused by the onset of news from the Ukraine and the Crimea. We haven't hardly heard any news from there lately. And so the market has gone back to sleep and is very quiet and all-time new highs. So that's a time to be cautious, but disciplined. Looking at the percent R, we are overbought, have been that way for 10 days. It can stay that way for a long period of time. So this is really the place to be buying dips and attending to your stops, finding those relative strength winners and owning them. The percent price oscillator, which has been a reliable indicator of intermediate term trends, opened up to the upside 10 days ago. It remains open and still strong. The 30-period regression line slope has improved. to almost a 60-day high. That's the slope of this black regression line in the middle. The channel is formed by the max excursion during the look-back period that supported, that was based on a pullback on the south side here. And it's up near the top of its channel. The 10 period is steeply up, 10 days in a row of gains. So we'll see how long that lasts. Again, I'm ready for one-day VIX trade days, but in the meantime, I want to own those long, strong sectors. The fact that ADX has just moved above 20 is instructive, because that says there's another 10 points of ADX improvement still available. If we look back in the February time frame, the ADX reading got as high as 30, and that was the tail end of a nice bull. And so there's more room for this to go. It just got out of a 60-day basing structure here between 184 and about 188, and now has decided not to look back. So be positioned accordingly, but respect how fast the truth can change. Looking at the ETF2 regional report, we have all 10 sectors now on a buy signal. That puts us at 100% invested, 0% cash, bull quiet mode. The SPY at 53 on the strength is better than EFA, which is 53 on the strength, but the tie goes to the U.S. because it's at 61 on the average, and EFA is 58 on the average. So the U.S. has been just a little bit stronger on the quality scale, which is the risk-adjusted component of this model. Inside the U.S., the strength is in the S&P, then MDY, then the Qs, and followed up by IWM, which has started to make its nice turnaround move. That's one that we played with great relish this past week. We had a very nice day a couple times this week in the live trading. It was remarkable. The two strongest sectors, emerging markets and Latin America, and the two weakest, the Russell and Japan. Inside the U.S. sector spiders, energy is the strength, followed by utilities. Financials are really interesting because they are in the yellow on strength, but they just broke out to a 52. I'm sorry, not a 52-week, a 2-year high on Thursday, and there's no resistance overhead. So if you want, I think we'll have a chance to take a look at AXP as an example of a low risk idea and following through on momentum. So we'll take a look at that one. World market model is up next. All of the large caps and mid cap value in the U.S. are above average. The remainder is below average. U.S. real estate dominating here among the other asset classes. Treasuries are actually doing well. Gold and silver just getting crushed. The Asian country, Asia less Japan, is above average with real strength in India and the Philippines, with China lagging. Latin America itself is dominating, with Brazil being the superstar in the Western Hemisphere. Among the European countries, Spain, Germany, Belgium, Switzerland. A dead heat between the business sectors, both globally and U.S., and the strength has been in energy globally. Top 30 ETFs using that ETF2 model, very similar to the findings of the blended month rebalancing. So I'll let you just read those. The U.S. real estate is a nice, nicely positioned here. The Dow 30, through the same lens. I like the ones that are green on strength and white on consistency. Consistency is the 10-week slightly weighted average of strength. So when you have something that is in white on consistency, that means it's been above average for 10 weeks. And then when you see the strength turns green, and then that means, and recently it has just started to really outperform. So something like Cisco should get our attention, as does Travelers. Whereas something like Merck is white then green. It had been great for 10 weeks, but now it's started to underperform. So you would rather shift away from that and look towards the new emerging leaders. And so Johnson & Johnson, Intel, and Caterpillar are the kind of the no-brainer winners because they're green on both strength and consistency. At the bottom of the stack, Pfizer, Nike, Goldman, and you can see Visa getting progressively weaker, stronger at the bottom because it's red on the long term and then yellow on the strength. So that may be something that's making the turnaround and coming off the bottom. And American Express I like because it's white and yellow. So it may be earlier in the turn compared to these green and white ones because it's still showing improvement, but it has not yet started to dramatically outperform. So that's the Dow 30. Quick look at the very liquid tradables. These are the top 30 ETFs based on their average daily dollar volume of trade for the last 30 days. And then the ATR percentage shows you how relatively volatile they are compared to the stack of all ETFs. The ones that are in the green are both very liquid and very volatile intraday, meaning great intraday candidates. So the Russell, the VIX, Brazil, gold miners, and oil and gas exploration and producers are favored for that reason. Very liquid, very volatile intraday. Shifting now to the daily report from Friday for Monday. You can see just how long we've stayed overbought on NDX. You can see the decline of volatility here based on ATR percentage. We're at a 100-day low right now. We have swing setups in the treasuries for channeling and overreaction. And then the Autoframer shows a number of symbols that test out better than 2-to-1 on a retest of their 10-day high. VIX and gold comes as no surprise. Cliff has been a fantastic trade vehicle and is near the bottom of the channel after a month-long decline and resting on an important support level. So that's of interest to us. Winners have been these 10-day min pains. United Tech, 3M, Boeing, AXP, American Express, Goldman. The 10-day max pains, Pfizer, Verizon, AT&T, Visa, and Merck. It's hard to get a lot of swing trade setups on a runaway up market simply because there's no pullback that we can then measure our risk reward against, so there's not that many patterns. However, we do have ways to identify those relative strength winners, and if they continue to outperform intraday, that becomes a nice way to do swing trading one day at a time. We did a lot of that this week. Looking at the Dow tactical summary, nothing fires on RSI2. You have a lot of froggy candidates. These numbers over here in the green under the NDX, these are things that closed at new highs during the look-back period. So 3M closed at the top of its 10-day, 1-month, and 3-month previous high, as did United Tech and Boeing. I've added for you the gain stat column, so now we have the full range of stats near the range stat, the frog SD, frog quality, the gap stat, gain stat, fail stat to support that intraday framing for swing trading one day at a time and to improve your intraday practice. The ETF 30 through the same lens, the ones that test out better than 2-to-1 on the Autoframer are things that typically are oversold, like the FIX, gold, mixed commodities, ag, treasuries. You see Brazil and Latin America were big winners. again on Friday, as was XIV, which was up 5% on one day, up 15% on the last 10 days, 27% over the last month, etc. So you have 5 that test out on the Autoframer, and then treasuries are offering the channeling and overreaction, and just a couple dojis in Brazil and silver. So Brazil is ideally postured for a continuation play on Mondays. That remains one of my important intraday targets in order to take advantage of the relative strength it has, and then also if it starts to fail on a down day, I can hedge that and use that to hedge against itself in my longer term accounts. So it pays to know those longer term positions and then consider using the intraday or the swing trading to act as either reinforcement or the hedge. Moving on to the Autoframer is straightforward. It just shows the reward to risk on the basis of a retest of the 10-day high, which you see under the initial target or the I target column. That's the 10-day high, and the risk to reward ratio. And in almost every case, the Autoframer is selecting a 1 ATR risk as the middle of these 3 risks that are possible. The minimum ATR risk, which we put at a quarter, the range risk, which is yesterday's range plus that 10% buffer, and then the maximum ATR risk of 1 for framing purposes. And you can see we've got a lot of nice reward to risk ratios here. Just a quick look at some of the market mosaics. I'm going to leap ahead here. We're going to look at the slope of the 30 against the long-term 10-year statistics. And where we're at right now is that the slope of the 30 just hit a +1 SD. And so we are now kind of like officially in a very positive mood and move historically. The thin black line is its own 10-day moving average. And so whenever that slope of that 30 rolls over and crosses its own 10 outside of this +1, -1 normal range, that has always marked an important turning point in the market. So here, not this one so much, but we're now at the point where a sharp reversal has implications simply because it's been so powerful. Again, you can see the volatility spike. This is a 10-year chart here, chart number 5, and the bottom chart, chart 7, it simply zooms in over the last 200 days, so you can see what that path looks like and where we are historically. I like the slope of the 30 as an important indicator to the swing trade market health, if you will. I'm just going to flash through some of these. No need to talk about these right now. Only on this one, what I want to talk about is the susceptibility of the market to sharp reversals. Just to take a look at the 5-day holding period in the S&P looking back 10 years. You know, the worst 5-day period was almost -20%. It was a negative 7.6 sigma event. The current reading is we're up 1.28% over the last 5 days, which is a 0.42 sigma. So we're not at an extreme location yet, but just to show you just how significant those reversals can be and why at the peak of a market that is starting to run away to the upside, you really need to attend to your stops and make sure that you've got those in place when the market is healthy so that you're not squirreling around with that when the market reverses. The swing trade Z-scores takes the same idea, only now looks at a wider range of symbols. We've been trading Cliff hard this last week because it has been out of step with the broader market. It's got some serious structural issues. And then you can see Japan's actually been pretty good over 40 and 20 days, and the Qs are finally starting to come around. And Latin America had been lagging, but is now starting to move again. So there's still plenty of room for it to go. It's not anywhere near overheated on the basis of its 5, 10, 20, and 40-day holding period. So I would add that to my answer to Daryl, is simply we don't have a sense right now that Latin American emerging markets and Brazil are seriously overheated over these swing trade time frames. This one just shows the Z-score of the 3 important regression lines, 10, 30, and 90. It shows the Z-score of their slopes. The 10 has come back to the edge of the river. The 30 is right at the edge of the river. And the 90 still inside the upper half of the river and improving. And now you can see that we've just started this move out of the river. The jaws of the river starting to get wider with some price performance improvement. And so the nearest place that was back here. And you can see it went up for a little while, then a sideways period, and then a retest of the low. So we're going to be sensitive again that the index can retrace, but after a 60 period pullback, or a sideways, like a sideways quiet in here, this is the next leg up, and so there's still room for it to move $5 to $10 higher on a technical basis. Frog quality number holdings. We're going to scroll through these pretty quick. Nothing I really want to cover on there. I do want to go to some charts of interest. Stand by. It's not loading for me. Hang on. Puyi had a number of questions here. Looking at IWM about the quiz on Thursday. I'm gonna cover that. What conclusions do I draw about swing trading? If I was going to be a hardhead, what I would say is I'll answer the question after you post your answer in the chat room in order to get you emotionally committed to the thought process. That's how you really learn on those quizzes, is by going for an answer and then comparing your answer to what else is posted. You'll get a lot more out of that than just asking me a question and listening to the answer. If you put some effort into it, you're going to get the better payoff. However, I am going to answer the question. Now, just something that I want to illustrate here, because it'll show up when we talk about these 4 regression lines. So what we're looking at here is a daily chart on XLF, and I've turned price into a 2-period Bollinger Band. That's that orange-looking ribbon. And then what we have is the usual 4 regression lines. The 10-period is the blue, which I'm highlighting. The 30-period regression line is the smoother black line. The 90-period is this green line. And the 270, so it's a double long term, is this purple line. Now, free stock charts allows you to put a indicator on an indicator. And so what I've done here is in this gray shaded area that looks like a river, but looks a little different than what you're used to, is simply a 30-period Bollinger Band plus or minus 1 on the 270 regression line, and we treat it as a noise barrier between price and the 270. So when we take a look at financials over the last, I don't know, this is probably 90 days or so, what I want you to notice is that financials have been in an upward trending market. But what you can see is the river got a little bit narrower in here. That means the 270 started getting flat. And so the noise level gets thinner because the market is certain that, yeah, the 270 is flat. And now at the very end, you'll see it's just starting to hook up. This dotted purple line is an extension of the regression line, which might show if it just followed its current path, where it would go. Now, what I want you to notice is in these shaded yellow areas, what we have is extreme divergences between the 270 regression line and the 10-period regression line during a swing. And I want you to notice just how quickly the 10-period regression line adapts to price. There's hardly ever significant deviation. And so for purposes of this spreadsheet I'm going to show you and this opportunity ratio, we're using the regression line 10 as a proxy for price. And we're looking for moments of maximum divergence between the RL270, which to us is the long-term time frame, two time periods above. And so if we are tactical traders, that 270 reflects the strength of the trend of the industrial holders, you know, the guys that are pulling the 20-mule team wagon, that are very, very slow to change their mind. They want to own the best of the best for as long as they can, and they don't even pay attention to the tactical noise. So whereas a intraday or even a short-term swing trader can find an advantage in here, that long-term trend doesn't even budge. It's just long-term owners of a powerful trend. And what I've shown is, and the red line is just what those local lows and those support levels are. So I see two cycles of a divergence away from the 270, a higher low a couple times, and then another cycle where it repeats. And now in the blue circle, we show where that, how close that regression line 10 gets back to the 270 in each of these responses. And so in the first one, you see it gets to the midpoint of that gray dragon. Then it gets to the edge of the gray dragon, almost to the 270, and then finally touches it for a couple of days. And then exceeds the 270 on this excursion, where it chops around before then it fails again a significant distance away. A higher low to start this next cycle than it did previously, but after struggling to break out, it failed and then made an extreme move. And now this is a move from 2050 back to 2250. Ladies and gentlemen, that is a 10% move in the financials, and that should get your attention. Now here, when it gets up and tests the 270, now it's able to actually breach it 3 times, but has a hard time pulling away, then fails, and now the cycle begins again, the second, the third, the fourth higher lows. And now this time, instead of hesitating at this horizontal 270, it now has broken out. And so as a way to start measuring the potential upside breakout, there's a couple ways we might do that. One of them is to simply say, let me connect parallel lines here to this generally rising trend, connecting the lows and the highs, and I get something like the blue line channel. I can also take the size of the divergence away from the 270 on the downside and add that to the 270, and that shows us the yellow bar, which would suggest a move potential up to about 2375. If I take and extend the blue channel, I might come up with a 2325. So at least a 50-cent move based on where price currently is. So we see some upside, a way to measure upside potential even when we are at a 2-year high, which is what this reflects. So the next thought that occurred to us was to assess the size of the opportunity. If we say that the opportunity is the distance between the RL10 and the RL270 in our tactical time, how good is that opportunity? We could use that to compare among different candidates. So we said, since we're talking about swing trading, let's simply take the ATR percentage, one of them, and use that as a way to define risk on a normalized basis, normalized to the instrument's volatility, divide the opportunity or reward by the risk, ATR percentage, and compute an opportunity ratio. In this particular moment, we had something like a minus 1.14, and that's simply that it was relatively close to the regression line. When we were back here, that 2050 to 22, that was a 10%, and the ATR percentage was probably pretty close to 3/4. That would give us something like a 10 or a 12 to 1 reward to risk ratio inside this extreme pullback. So in a bull market with significant pullbacks that have started to resume, if you simply trailed this sell-off with a 1 ATR buying stop, you'd have been stopped into the buy position and made some nice trades. So this is an extract of some of the sector spiders. And this is what we're talking about when we say the opportunity ratio and the regression line fractals. You could also use the frog statistics on XLF, which give you a daily frog box of 7 cents, a weekly frog range, a weekly frog box of 23 cents, and a monthly box of 35 cents. So if we now estimated the potential reward on the excursion at something like 75 cents or $1, that now looks like a very interesting move when we look at the normal ranges over these different time frames. Even on a monthly basis, this would represent a 3-to-1 reward to risk ratio. So this is a way we think we can start calibrating quality in the swing trade domains. I'm hoping to see, I think I have IWM in here somewhere. If you hold on, bear with me. What I want to show you here is this was a 2-day intraday trade in AXP, and what we had was we just called this one stacking boxes. And let me go back to an earlier one. This is actually this is XLF. This is the one I want to show. These green boxes here are 7 cents. That's what an intraday move using the frog boxes when a sector has made its turn and is now leaving its daily 270 behind gives you a nice tactical signal here, intraday outside the river early, and then marches steadily all the way up for a three frog boxes in a row. The leading candidate for interest for us was AXP, and so that's where we will now come and look at AXP. Oh, I'm sorry, this is XLF again, but this is instructive. So now we're going to look at a frog box of 7 cents, and this is what that day one of the nice swing move looked like in terms of a 7-cent frog box. This was that RLCO that we just saw, and now we've stacked. It's going to make a 7 frog box move without ever looking back over the next 2 days. And it simply moves up with efficiency, finds support, keeps taking off, moves up sharply in the morning, and this was at a 2-year high as well. As soon as price takes out the previous day's high, you can buy that. The sector was strong. It's at a 2-year high. There's no resistance overhead, and the frog box is only 7 cents. And so even on the second day follow through, there's a 2R-ish kind of move inside here. Puya asks, is there a way to place the 270 RL for a target of intraday position? Certainly. Just know what it is on a daily chart and draw a horizontal line. This is interesting here because this relationship between the RL 10, 30, 90, and 270 is the same intraday on shorter time frames as it is on the longer term. I cannot emphasize that too much. the relationship between the regression lines based on ratios is identical regardless of the time frame. So it works very much like the RLCO river in that sense, that you can interpret price action tactically based on price, location, and behavior in the river, and you can use those regression lines for targets as well. So what we have here is on the 3-minute chart, this monster is just moving steadily northward, and you can see the 270 has hardly ever budged after a period of being flat, and now it's just steaming north. And the 90 is leading the way, and the 10 and the 30 are just chugging right along inside a tightened river. And that's what we were laughing about. Like, this was a mule team. This is institutional money buying financials at the highest high of the last 2 years and just marching that thing northward with no intent to sell. The mule team has left the river and is marching northward. You know, this blue line is a simple representation of that. At any given moment, the difference between the 10 and the 270 sort of shows you what that moments of extreme divergence. What we came to conclude was that the 90, which is intermediate between the 10 and the 270, if you bought this position early, when the 10 crosses the 90, it looks like halfway through, and be alert and respect the move that you just caught. And then you can see how the river is collapsing and giving you a sideways quiet channel. That's the time when you can say this early morning move is over and you want to really respect your stops. And then we get a slight move into the close. And then the same thing happens the next day. Buying it early, it steams north and starts to relax. Then when the 10 crosses the 90, you have the intermediate term. When everything comes back to the 270, you have the end of that journey. So you have two nice daily legs intraday. And you would interpret that the same way intraday as you do in the daily chart that we looked at before. Very powerful idea. I mean, we almost fell out of our chair the more and more we looked at this during the week. So here's the move in AXP. Same idea. This is those 2 days, but now expressed through AXP. And I want you to notice that the RLCO is deeper on the Thursday move, and the ascent is sharper. And you can see when price is pulling away from the 270 how you get this really nice move to an extreme. And then when the 10 comes back and crosses over the 270, that's telling you respect your stops. And then the next day when this takes off, you cannot draw a more efficient upward line than AXP did on Friday. I mean, just take a look at that. That's what quality looks like. And then finding those relative strength leaders intraday in strong sectors and buying them as they're rising is the idea of Wu Wei, or effortless action. And we also remember that, you know, the power of the wave. Take a look at this. Is the Great Wave at Kanagawa looking on Mount Fuji, one of those classic 50 woodcuts by the master back in the 1800s. And you see this underlying surge of strength, which then crests and cascades into froth, and then that same wave gathers strength and then takes off even stronger the next day. And so we are reminded by our trading mentor here, Sun Wukong, the Monkey King, be disciplined and be lucky enough to be well prepared. So when these move happens, it looks like effortless action, but it's based on the power of preparation. Be lucky enough to be prepared. This is what AXP looked like on the intraday on day 2, and this was on Friday. The early gap up out of the river, out of the floodplain, up we go, a new 2-year high in financials. You can buy it anywhere in this curve. Hey, when the 90 crosses the 270, that's an RLCO of the slower pair. The relationship between the 90 and the 270 is the same relationship as between the 10 and the 30, but on the next higher time frames. That's how you can look at the higher time frames and see evidence from that higher time frame influencing price. So you've got what you love right here is the 10 better than the 30, better than the 90, better than the 270. And even the river is flowing north of the 270. This was an important moment. You had to be buying it here, not later than here. But because of effortless action and good prep, we were able to get in this early. And then this is where that wave starts to crest from the edge of the floodplain and now starting to roll over, and you get an RLCO. That was a really nice move on a very efficient, orderly move. So now let's take a look to answer your specific question on the quiz. This simply takes the difference between the 10 and the 270 regression line, divides that percentage by an ATR, and then computes an opportunity ratio. And this was the quiz. What conclusions do you draw about swing trading IWM? That when you get out here past 10 and 5 here, you are at an extreme location, and you've got a really nice, you got a 15R potential move in the other direction because of the strength of the excursion, snap back to the mean. We're going to take a look at this time period here. These are a lot of smaller moves, but those tend to be about 6 ATRs in distance. So if you can manage 1 ATR of initial risk on a swing trade and then grow the position, you have a potential series of 6R trades. Or if you need 2 ATRs to manage, you have a series of 3-to-1 reward to risk whenever this reaches an extreme and starts to roll over. So if we zoom in on that, and this is in IWM, by the way. If we zoom in on the last 400 days of IWM, the length of this vertical bar is 6 ATRs. And the thing to notice is that IWM had a distance to go till its daily 10 got back to the 270. And we did this one before that really powerful move on Friday. So this is going to be a standard practice now for me, is to evaluate a large number of symbols or potential targets simply on the basis of this reward to risk ratio, or the opportunity ratio, if you will. This was an example of, no, it's in either direction, Puya. Yeah, when you get to an extreme, just take your pick. So this is an intraday trade with XIV, excuse me. So this is XIV, I think the 5th, I think was that Thursday? 7, 6. Yeah, this was Thursday. And we had a nice gap up, and now this is 3-minute charts, and you can see the 270 is the train leaving the station. That's the direction that they're pushing it. And this little boundary, this gray area, is the noise level around the 270, sort of like a river around the 270, not around price. So if price violated the 270 at some point, I really think it has to get through this range for it really to be a significant move. So it's not just crossing the point. It has to get through the noise area. So when on this little pullback, I would think it has to be down here for it to be significant. But we like this one. It was a gap up, made a morning hook, and then started to take off. And so we're able to manage this size of a stop. So we bought one here, bought one here, bought one here, sold it here on some hesitation, and banked 6.5R. And then it almost immediately resumed after we sold it. So we bought it again, put one of our 6 back to work, got it at 40.45, cashed it here for an extra R. So there's 7.5R intraday on that first move. And now what I want you to notice is right around in this region is the 10 crossing back over the 90. That's sort of the first half of the move was this one. This is the intermediate stage, maybe the point of no return, if you will, or the time that says When it's sideways, if you're still in, you have to be protecting some portion of your initial gain because it's now closer to the station, the arrival station, than it was the departure station, if you follow the analogy. And then now here, by the time everything comes back to the 270, everybody agrees on every time frame that we have something that is fairly priced. So yeah, you can see guys playing tactical games down here, but now this is an image of contentment. The 10, the 30, the 90, or the 10, the 30, the 270 have all come back. There's still some residual goodwill up here to the 90, but that looks like the upper move of the day. A rebound move should be able to get to here. It really takes now a breakout above this to be very interested in XIV for the rest of the day. And now you can look to see how much time is left and answer the question, do I have the time, will, pattern, and money to continue to trade this intraday? I have to have all four. Is there still enough time left in the day to start taking advantage of that opportunity? That's how that works. So here's one that we did on Microsoft that turned out to be outstanding. We were now looking at, on a different time frame, just to illustrate the point, we're now looking at 30-minute charts, Microsoft excursions. So we had this period of sideways quiet channel. We had an SQC breakout on the river on the tactical screen. And then we have this. This is a 50-cent move in the green highlighted area. We had a 50-cent move here. We had a 50-cent move from that excursion back to the 270. From blue circle to blue circle was 50 cents, or one of these green bars. And then from the 270 to the RL10 during its maximum excursion, that was 50 cents. And then it's a 50-cent move from here back to the 270. So we said, is it possible, as this thing now breaks out through the 270 to the upside, could we see a 50-cent move to the upside? Yes, we can, because it just did that. And so we're able to play a stop here at 40.44, buying the next little bit of strength at 40.60. That's a 15-cent initial risk and a 50-cent opportunity. That's 3.3 to 1 reward to risk ratio. Make that trade, and almost immediately after, it makes that move to 41. And so that's a relatively slow intraday time frame. We're looking at each one of these is days. So this is day 1, 2, 3, 4, 5, 6, 7, 8. 8 days and 30 minutes gives you a nice time frame to look at swing trades. It also works on 2 hours, but I've been leaning towards the 30 minutes because it's 10 times higher than my preferred 3 minutes candles. When I'm looking on this kind of a chart on the 30-minute and I see that opportunity developing, I can dial it down to a 3-minute chart and then exploit some tactical price action patterns in the usual way. All right, so just some ideas to share with you there. That's what the regression line fractal 4 is starting to look like as it unfolded in our mind. And so I'm building a spreadsheet if this thing will work for us here. Hold on. Let's see which one we're looking at here. This is SPY, just as a way to characterize this. When I look at SPY, what I'm computing I'm going back 270 days now to pick up the forecast for the 10-period regression line forecast and the 270. And now in this section here, I'm computing the raw difference in dollars, turning that into a percentage, finding the Z-score looking back 270 days, the ATR percentage, and then finding the opportunity ratio to compute the value of the particular trade on that particular day. Right? And so this is the pattern of the S&P over the last 5 years. And what you can see on this is that right now the S&P is sitting right on its 270. The 10 is right on its 270, pointing up, but there's no, everybody would agree that that is fairly valued. There's no, we're looking for moments of interesting excursions, right? So if that's what the details of a single symbol look like, when we can take a look at this. This is the very rough form. I don't have it ready for publishing yet, but what I'm looking at is this is the most current readings for a particular day, Friday, at the close on Friday. And I just put S&P and IWM here. And so F10 and F270 are the forecasted value by extending the 10-period regression line and 270 regression line by one more day. That tells you what the fair price ought to be. And then the difference between the 10 and the 270 gives you a raw dollar value of the opportunity. In this case, the 10 is above the 270, so it's made an excursion of $3. And so on a reversion to the mean or a reversion to the 270, it's a negative 1.54%. The current ATR reading is 0.59% in the S&P. That gives you a a 2.6 to 1 trade if the 10 were to go back to the 270. That's how far up the 10 is stretched above the 270. 2.6 ATRs. On the positive side, IWM, the 10-period forecast is below the 270 forecast, and that's a $3.50 opportunity, which works out to 3%. And the ATR is 1.39%. That's just a little over a 2 ATR move to go north. So that's how much catching up it has to do. So now we could simply take what I've done here is I've taken the Dow 30 and the ETF 30 just for demonstration purposes. And if I sort by the opportunity ratio, what we have right now is this minus 9.31 simply says that IYR, U.S. real estate, is 9 ATRs higher than its 270. So it's already way up here. It could fall 9 ATRs back to its 270 regression line, and so on. So you might be interested in the ones that are pulling away. These are all the relative strength winners. So there's your Intel, XIV, Cisco, consumer staples, emerging markets, etc. And then if we go to the downside, you see things like CLF is 9 ATRs below its 270. So its 10 period is at 14.25. That's the proxy for price. And its 270 period regression line is at 20. So and its ATR percentage is 4.27%, but it's 40% away. That works out to a 9.3 to 1 reward to risk ratio. And so IWM actually stacks up pretty nicely in terms of opportunities in that stack. The other thing that you like to look at, I think, is these that are in here around 0. The ones that are around 0 are ones that have come back into the station. So this is Goldman Sachs. And these are ones where those regression lines are pinched. And now the excursion could be in either way. You know, a couple 3 ATR in either direction is not unreasonable. So that's like a sideways quiet channel breakout is the absence of an opportunity ratio. It's implied simply based on how far it's gone historically. So you can always count on 3. So things that are in there less than 1 and greater than -1, so plus or minus 1. Those are things that are postured on a daily basis as a sideways quiet channel kind of an opportunity. The channel could be tilted, but it simply says is that all these different time periods are estimating that it's at fair value. Okay, so that's just a rough look at a spreadsheet that I'm building to clean up. But I've already started using this personally to give me some insights into the kinds of patterns that I want. I'll have more to say on this and do a separate video. There's a couple videos already on YouTube. The last two were an examination of CLF and XLF. So you can look at those. And we recorded those right after we had taken the trades. And we're looking at that. This RLFF, regression line fractal 4, is a way to calibrate our trade management during the week. That's the kind of dynamic that happens at the live trade workshops. It was really quite powerful. And we had so much fun drumming that we stayed till 9 o'clock on Friday and kept drumming. That's just how much fun it was. A real sense of camaraderie and mutual support. And it was just a nice way to raise our energy and whatnot. So I'll get a note out this week about the next one. It'll probably be November to give us time to plan it and for people to arrange their travel and to fit into the soccer schedule. So I see we've already gone an hour, so I'm gonna cut it there, and I'll get this recording uploaded to YouTube for your subsequent review. So pending any final questions, that's everything that I have. Let's see, there was a question here, sorry. Aaron Woodard asked, send me an email to longke@yahoo. Just send me a note. I'll send you some info. Puya says, yeah, now I'm telling you that there could be an RL 270 target. Yeah, absolutely. I'm looking at that primarily to supplement my swing trade framing. There's a lot of folks that are looking for more precision on the reward to risk ratio. All we've really done is, with this RLFF idea that I just briefed you, is look at swing trade auto framing from a slightly different lens than the 10-day Autoframer. If you think about the Autoframer, that's taking a standard price target of a 10-day high as a reasonable short-term profit target. And that's a good idea for swing trading one day at a time. But if I want to have something that is a longer swing trade, I want to hold this thing for 10, 15, 20, 30 days, I can now auto-frame it using this RL270 as a long-term swing trade or position trade price target. And when I get significant 10-period pullbacks away from that as measured by the RL10, and now the difference between the regression line 10 value and the RL270, I now have a way to auto-frame a much longer-term time frame. And now I want you to explode your mind with this idea. The stronger the upslope in the RL270, the more you want to trade the long side when that RL10 reverses against it. So you have a very strong long-term price pattern that turns very slowly. That's the long-term, that's the fourth and fifth mouse. And now you have a short-term excursion away from it. That thing can pull back, like we see in Cliff, 10 ATRs. And when it starts to turn, maybe you just want to wait 2 ATRs off the bottom. You now have 8 ATRs to the upside just to get back to the 270. Well, it turns out if that's a really good long-term swing trade, if it starts working longer term, you can then start turboing that with shorter-term swing trades and intraday turbo using the RLCO. So I want you to see these as mutually supporting. It also turns out that when you dial down your time frame and go intraday, the RL270 adds information to what we already know is good information in the RLCO framework, which uses 1030 crossovers. The 270 is another way for you to see what the longer-term time trend is on your intraday trading. I will have more to say about that once I write it. Okay? So that's enough. The dogs want to come in and basketball's on. Let's go Spurs. Take good care, and we'll see you in the chat room. Keep your risk measured and your powder dry.